everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us. Uncertainty abounds when it comes to the markets these days, but are the signs really pointing to a recession? Joining me now to discuss this is Matt Orton. He is the Chief Market Strategist from Carolyn Tower Advisors. Matt, very nice to have you on the show. We are talking a lot about recession fears. We're talking about concerns from investors, and they're getting more and more concerned that a recession is imminent. There are lots of talking heads out there, and they shall be unnamed at this point, who are really dropping the R word quite a lot. So not surprising, we've had talk about yield curve inversions. We've had continued talk about rising inflation. Before we get into some of the signs that you really see out there, what do you feel, Matt, is the cause for this uncertainty? And by the way, great to have you on the show with me.
Yeah, it's great to be here, Anthony. Thanks for having me. And I think uncertainty is really a great term to use because that's where we are. The market is really pricing in a recession at this point. And I think a lot of those fears are overdone. And really, the main reason for a lot of this fear of a recession is that we're now facing, for the first time in a very, very long time, real inflationary pressures. Some of the recent data that we've had with respect to consumer prices increasing at the highest rate since 1981. You're seeing producer price indexes increasing double digits. So there's a lot of reason for investors to be worried about where we are. And then add to that some of people's favorite metrics to predict inflation, to predict recession, which is the 2-year, 10-year yield curve and the inversion that we got. I think really spooked a lot of people. But when you actually look at the data, I don't really think there's a reason to take that to heart, especially the 2-year, 10-year curve. I don't think it's a great indicator going forward. And if you look at all of the past inversion points of the 2-10 curve, it doesn't spell doom for equity markets. In fact, when you look at the next 1 month, 3 month, and even 12-month performance of the S&P 500 after you have inversion points, all of the performance is positive. And over a 1-year period, it's positive to the tune of double digits a majority of the time. So that's not a reason in and of itself to be worried about the market. And so I'm still optimistic, and I'm not in that recession camp right now.
That's great. Yeah, and I appreciate the fact that we're talking about the optimistic side of the story, which is also the story that our Chief Investment Office here at UBS has been talking about. But I wanted to look at some more signs with you, Matt, that do give you some of that optimism about the path of the U.S. economy. First off, the moves being made by the Fed. We already talk about this ad nauseum. They're designed to curb inflation. We just threw up a chart of CPI. We know it came in at 8.5% for the most recent period, and that is a 40-year high. But historically, how was a rising rate environment impacting markets? Because it's not always a bad news story when you see the actions that the Fed has taken versus some of the historic charts that you can look at.
Yeah, that's exactly right, Anthony. So when you actually look at the past inflation or the past Fed rate hike cycles, you don't tend to see that equity markets perform poorly. In fact, when you look at the previous 4 rate hike cycles, equity markets actually have performed on average over 6% over the next 12 months past when the Fed actually starts to hike interest rates. So again, the Fed hiking interest rates is not a reason in and of itself for markets not to perform well. You tend to see a little bit of market volatility at the initiation of a rate hike cycle. And I think that goes back to what we were talking about just before about uncertainty. Investors, there's always going to be uncertainty with respect to investors when you embark on a rate hike cycle. But once you get into it and you focus on the fundamentals of the economy and the fact that the Fed feels confident enough to keep hiking rates, usually that spells that's good for equity markets going forward.
Yeah, and look, Matt, we know folks are really concerned also about, talk about inflation, this rise in energy prices, and something you say in a report that I read, you say we've been blessed with cheap oil for too long, which if we all think about the trading patterns of oil over the last decade, 2 decades, you're not wrong there when you look at the chart. So I would love for you to walk us through your thinking here when it comes to energy prices.
Yeah, that's a good point. I think some of the uncertainty that we have right now also comes to the fact that we've got a war going on between Russia and Ukraine, and we've seen just an absolute surge in commodity prices, and namely energy. So the price of oil has spiked. But we really have had very low crude prices and very low gas prices for a long time. And when you look at oil prices pre 2014, we really had a crash in oil prices towards the end of 2014. When you go back before that, really from the end of the financial crisis until that period, we were averaging $85 to $90 a barrel on WTI, and gas prices were between $3.60, call it $3.85 a gallon. So we have this isn't uncharted territory that we've been in. I think the pain is just especially painful in our mind because we've anchored ourselves to artificially low prices because of the demand destruction we had with respect to COVID, and we've just gotten adjusted to low oil prices for a couple of years. And so the pain we think we will feel, or the pain that we feel, might not necessarily actually play out with respect to our finances going forward. And we haven't really seen that sort of demand destruction that I think a lot of people are forecasting when you look back to the period between 2011 and 2014, when you did have very elevated oil prices. That just didn't happen then. And the economy now is in a much better place, I would argue, than we were back then, especially with respect to the consumer being able to afford the higher prices of gasoline.
Right, and something else that you note in a recent report is that U.S. households right now are in the best shape versus many developed countries around the world, something like 12% excess household savings percent versus GDP. So clearly there is a lot of savings on the sidelines. Perhaps people are not investing. Maybe they're still a little cautious about the markets, but the household savings are certainly there. So it makes sense when you look at the price of oil that it's something that for most families they can actually afford this spike. And you just talked about it back in that period about 14, 13 years ago. Oil was up $140 a barrel, which is lower than where it is right now. So it's something, as you said, we've gotten used to these low prices, so it's tough to maybe switch back again. But, all of this actually feeds into uncertainty because clearly, you talked about the war in Ukraine there for a moment, and we're still in the middle of a global pandemic, even though it's not at the severity where it was 2 years ago, a year ago, but it's still out there and people are still getting COVID. Hospitalizations, thankfully, are lower, but it's still a cause for concern for many people. So what's the correlation between all of this uncertainty and consumer confidence? Because that's really what plays in here when you look at what the consumer is actually thinking.
Yeah. And I think, Anthony, you've got to separate what the consumer is thinking or feeling and what the consumer is actually doing. Because consumer confidence, consumer sentiment has really just hit a brick wall once we hit COVID, and it really has not recovered ever since. And in fact, what I find just to be absolutely amazing is that consumer sentiment in the most recent survey was at the lowest level that we've been since 2011. So even lower today than we were during the depths of the COVID pandemic. And that's just mind-boggling because, as you said, the consumer still has over $2 trillion of excess savings just since February of 2020, still sitting on the sidelines. You're seeing wages finally starting to increase. So the consumer is, I would argue, in the best shape that they have been, having gone through a massive deleveraging cycle and increasing savings through the COVID pandemic, but they're still not feeling very good. And I think part of that goes back to a lot of the uncertainty that we still have. We're still dealing with the long-term impacts of COVID. So there's still some uncertainty there, or we still haven't fully resumed our normal lives. I think that weighs a little bit on overall sentiment. But when you look at what consumers are actually doing, people are still spending money. And in fact, we're spending more money today than we have been in the past. And I think that is really, really important to note. And I think what's really interesting, even just looking at some real-time data that we have from the very beginning of April, recent banking data is showing that the consumer, and particularly the lower income consumer, so those who make an annual income of less than $50,000 a year, their spending for the first couple weeks of April is actually 33% higher than it was in 2019. So clearly there's a big disconnect. And I always focus on what the consumer is doing rather than what they're saying. And that's why corporate earnings, I think, have been so strong and are likely going to continue to be strong going into the future.
Yeah, and I'll be curious, I'm sure you will as well, Matt, to see what the consumer confidence and all the sentiment data that does come out over the next few months and quarters looks like now that people are starting to spend. We know that people are spending money more than they have in the last 2 years on vacations for this summer because everybody cannot wait to get out of the house after being, kind of mostly quarantined for 2 years, whether they're working from home or they're just not vacationing because they don't want to travel. So very interesting stuff. But before we go, I have to ask you about the labor force. And when you look at some of the recent data, what can it tell you about the path ahead?
Yeah, I think when you look at recent labor data, it's very, very encouraging. So you're seeing labor force participation finally start to increase. So more people are coming back into the workforce. You're seeing wages increase, in some cases even more than inflation. So real wages in certain groups within the economy is actually positive, and I think that's helping to sustain some of the savings that we have. And what else is really interesting is that you're seeing wage gains accrue across the board. So you're seeing wage gains to both low skill and high skill workers. I think that's very, very important because it speaks to how broad based that the overall the overall wage increases are that we're seeing. And we're also starting to see job quits roll over. So we've seen a massive spike over the past, call it year, really 8 months in people quitting jobs, switching jobs, and you're finally starting to see that pause and come down a little bit. So that's encouraging. So I think from both an inflationary standpoint, perhaps the worst. We've seen the worst with respect to labor cost inflation, but you're still seeing steady gains that's broad-based across the economy. And that can help to sustain the level of consumption that we're seeing overall. So to me, that's also very, very positive. And I'll note, we're based down in Florida. And I'll say, just looking at the number of people who were down here for spring break over the past couple of weeks, hotel occupancy in our area was almost at 100% for 3 weeks in a row. And I couldn't even get reservations at restaurants that my wife and I usually, go to without thinking twice. So we are seeing people traveling. We're seeing people across all groups of economic income levels traveling. And I think that's very, very positive going forward.
Yeah, I'm as a New York City resident myself, I also can agree that it's getting harder to get into restaurants over the last couple of weeks. I think a lot of people come here for spring break as well. And you can see the lines around the block for certain places that are generally touristy are more than double what they normally are. So it's good to see some travel and commerce coming into the cities after 2 years of some tough times. So Matt, thank you very much. Appreciate this look at an optimistic view, I should say, of the markets as we move forward. So thanks for joining me, Matt. See you soon.
Great. Thanks, Anthony.
Anytime. And for more information and access to more UBS content and from our great partners like Matt at Orton over at Carolyn, you can visit ubs.com/views and make sure to follow us on social media. We're on Facebook, Instagram, Twitter, and LinkedIn. Plus, you can check out past UBS Trending episodes on demand on our website, ubs.com/studios, and the UBS YouTube channel. And as always, if you do have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.